Everyone, and good afternoon, good evening, or good morning to you all, depending on where you are joining from in the world. We're delighted to have you here today for the first in our series of webinars on the topic of Pillar 2. A couple of admin points before we begin. So firstly, due to the number of the people on the call today, your mics are all muted. However, we would, of course, love you to interact with us throughout the session. With that in mind, there will be a few polling questions as we go, and you're also welcome to place questions in the Q&A box through the session, and we'll come back to those questions at the end. We're, of course, also available for follow-up discussion after the webinar to address any specific circumstances that you have in more detail, so please do feel free to get in touch with the speakers today or your usual video contact. So, to kick us off, what are we covering today? Well, as you will no doubt know, Pillar 2 is a large topic, and so we are splitting the conversation on different elements into separate webinars. We'll provide more detail on the webinars that will be following today's session at the end of today's webinar. But today we're looking to provide you with a brief overview of the rules and some practical guidance around key steps that you could or should be undertaking now as we approach the commencement of the rules. In terms of speakers, we have myself, Ross Robertson. I'm an international tax partner, and I'm the global lead for Pillar 2 as we help businesses to navigate the complexities of the rules. We also have Ed Gibson, a fellow international tax partner, who is our global compliance and reporting lead. We have Michelle Wilson, who is a tax partner and our tax accounting lead, as there is significant overlap between Pillar 2 and tax accounting principles. And we have Meenakshi Iyer, who is a transfer pricing partner and our operational transfer pricing lead. And finally, we have Frederick Baloyne, who is our Pillar 2 lead for EMEA and based in the Netherlands. You'll also be introduced to more of our global Pillar 2 team, including our tax AI team as the webinar series progresses. So first, some policy background. Now, this is a sea change in relation to the international tax arena. There's 145 members of the OECD BEPS inclusive framework, and the substantive majority of territories have already or have indicated that they will proceed with Pillar 2 adoption. The OECD itself estimates that Pillar 2 will result in average effective tax rates increasing across all jurisdictions by approximately 0.6%. If you could move us to the next slide, please. Thank you. So what is Pillar 2 all about? Well, a number of you will know, but it's seeking to set a minimum effective global corporate tax rate at 15% to stop the so-called race to the bottom of corporate tax rates and to reduce the incentive for base erosion and profit shifting between jurisdictions based on the tax rates between those jurisdictions. So before we get into the detail, let's first bust a few myths. So the first one, I'm only in high tax countries and therefore the rules are not relevant to me. Well, the OECD estimates that high tax jurisdictions, being jurisdictions with average effective tax rates of above 15%, account for 53.2% of global profits taxed below 15%, which is actually much more than very low tax jurisdictions, so jurisdictions with effective tax rates below 5%, which only account for 18.7% of low tax profits. So you might find some surprising outcomes. Secondly, I won't have any top-up tax and therefore I don't need to do anything. Unfortunately, you will still need to prepare calculations to demonstrate there is no top-up tax, although safe harbors may help to simplify that process in initial periods. And we'll talk about those safe harbors in a bit more detail next. Myth 3, the tax return is not due until 2026, and therefore I've got a long time to work out what I need to do. Well, there will be a requirement to disclose the expected impact of Pillar 2 in your accounts for any periods ending on or after 31 December 2023, and work will need to be undertaken in order to be able to make appropriate disclosure in those accounts. 4, it's a group level issue and head office will look after it. So although the primary taxing mechanism is at a group level through the income inclusion rule, which we'll explain in a bit more detail later, most territories proceeding with Pillar 2 are implementing a domestic minimum top-up tax, and so the calculation responsibility can sit at a domestic level. There's also very likely a local statutory financial statements disclosure obligation in light of that. And as a minimum, even if there is no local compliance or a disclosure obligation, there will be a requirement to provide data to group, and systems and processes will need to be established to enable that. Next slide, please. So a bit more detail on the rules. They are drafted to apply to multinational groups with annual consolidated group revenue of at least 750 million euros in at least 2 of the preceding 4 years. The rules have been drafted at the OECD level, and you'll hear reference to the OECD model rules when people talk about Pillar 2. That is a framework which countries implementing Pillar 2 are suggested to follow, but there are certain deviations that a local country is permitted to take from those rules. So understanding the local implementation of the OECD model rules in the jurisdictions that affect you will be important. There are some excluded entities, but notably these are excluded entities, not excluded sectors and not excluded groups. So even if you have an excluded entity in your structure, there could still be investments of those entities within scope of Pillar 2, depending on your specific facts. Now, as a final comment, there is a country de minimis, but it's set at a relatively low level, and it is an and test of both revenue and profit. It may help simplify compliance processes in some instances, but it's unlikely you'll be able to rely on that in its entirety. Next slide, please. So in terms of the framework of the rules, there's a few different components to them, and I'll just touch on a couple of them at a high level. So the primary component of the Pillar 2 package is an income inclusion rule, which should be viewed effectively like a super controlled foreign company rule, providing taxing rights over low tax profits of subsidiary entities in the territory of the ultimate parent of the group. As a backstop, you've got an under-taxed profits rule, which operates in the same way in terms of the determination of low tax profits as the IIR, but it provides the taxing rights to a parent or brother and sister jurisdiction, depending on the specific facts of your group structure and how that interplays with which territories have implemented or will implement Pillar 2. Then there's a domestic minimum top-up tax, which territories are permitted to include, which works again on the same calculation principles in broad terms, but to the extent that there is a top-up tax due on low tax profits, that taxing right sits at the local jurisdiction level. So really that's just a question of where the taxing right sits as between the IIR, the UTPR, and the domestic minimum top-up tax. There's safe harbors that apply in relation to those, which we'll go through in a little bit more detail. And there's also a subject to tax rule, which we're not going to cover today, but this provides additional source territory taxation rights in respect of certain low tax profits on certain intragroup transactions that can override current treaty mechanisms. Next slide, please. So in terms of the computational approach, we would suggest generally a 6-step approach. First, some work to identify the ultimate parent entity and the constituent entities on a jurisdiction by jurisdiction basis. For many groups, that'll be obvious. It'll be the group at which the consolidated accounts are prepared and all of the entities included within those consolidated accounts, but there can be some nuance to that for more complicated structures. We then suggest consideration of the safe harbors, to try and simplify the compliance processes to then enable a more focused approach, at least in initial periods, to determination of the likely impact of the rules on your business. And we'll go through in a little bit more detail what that calculation looks like. Next slide, please. So I'll now hand over to my partner, Meenakshi Iyer, to talk a little bit more about the safe harbors that can provide some simplifying mechanisms in initial periods. Meenakshi, over to you.
Thanks, Ross. Next slide, please. So many of you would already know that there are some transitional safe harbors that the OECD have released, and some countries have already implemented, like the UK on the C/C basic safe harbor. And this is a relief in the interim, as Ross said, so that the groups don't have to actually prepare detailed globe calculations in all jurisdictions. So I'll just quickly take you through what are the key features of the safe harbors. The first one really relies on your C by CR data. And most groups would be already preparing their country by country reports, and therefore this data should be readily available. However, what OECD have said is that the C by C should be a qualified country by country report. And how do they define qualified country by country report? It is a report that is being prepared either using the financial statements, the consolidated financial statements of the ultimate parent entity, or if a bottom-up approach is being used, then financial statements of the constituent entities, which have been prepared on the basis of an applicable or an authorized accounting standard. Now, the applicable accounting standards have been defined in the Globe Rules, and an authorized accounting standard is a standard which is used in the local territory. For example, UK GAAP would be an authorized accounting standard. But the issue really is, for most groups, but everyone knows that C by C initially was introduced as a risk assessment tool. And therefore, although in the initial years, when the first time it was implemented, potentially most groups would have gone through the reconciliation, with consolidated financial statements, local entity financial statements, but that rigor may have dropped out over the years because there is no real audit of that C by C report. Tax authorities use that just to assess to determine whether there is a transfer pricing risk or not. But now, if you are going to rely on the C by C safe harbor, then you need to make sure that your process is properly documented, and you need to satisfy yourself that this would actually meet the definition of a qualified country by country report. Now, what are these safe harbors? So there are three safe harbors that rely on the C by C report. The first one is a de minimis C by C safe harbor, where if your C by C revenue in a particular jurisdiction is less than 10 million euros, and your C by C profit is less than 1 million euros, and that includes a loss, then you could qualify for this de minimis. Now, there is an important exception to this. So if you have a constituent entity which is being held for sale, and actually, therefore, you probably don't have to include it in your C by C, but by including the revenue of that entity which is being held for sale, or the profit, if you breach the de minimis threshold, then you can't actually rely on this de minimis safe harbor. But this is helpful for many groups in eliminating certain jurisdictions which meet this criteria. The second one is it is called the simplified ETR using the C by C data. Can you please move on to the next slide for this, please? So the simplified ETR actually uses data from two sources. The first one is the simplified covered taxes, which actually comes from the income tax expense recorded in the financial statements of the entities, rather than the C by C. Less any taxes that are not covered taxes, or you take out, and you also take out the uncertain tax positions. So that's how you calculate the simplified covered taxes. And then you divide this number by the profit or loss before tax from the C by C. And if this ETR actually is less than 15%, so the rates actually are different for different years. So it's 15% for 23-24 for fiscal years beginning 23-24, 16% for 25, and 17% for 26. Then you should be, if the ETR using this calculation is more than these numbers, then you can rely on the safe harbor. Sorry, not less than. So if you now move back to the previous slide. The third one is the C by C routine profits. So here, this is a substance-based income inclusion. So as you know, that the OECD had included certain substance-based income inclusion rules where they effectively said that, if your profit is a certain percentage of your employee costs or people costs, or a certain percentage of your assets, and if you make that calculation and that is greater than the profit before tax that is reported in your CBCR, then you can actually rely on this safe harbor. Now, the C-by-C based safe harbor can be used during the period which begin on or before the 31st of December 2026, and up to the time any financial year that does not end after 30th of June 2028. So you would have to do these calculations on a year-on-year basis. There is one more important point to remember about these safe harbors relying on the country-by-country report, which is once out, always out rule. What that means is if in a year you decide not to rely on this C-by-C based safe harbor, then you cannot actually come back next year and start relying on this particular safe harbor. So it's very important that you are able to you're able to do the calculations now and determine if you can rely on the safe harbor to simplify your life and the compliance of the Pillar 2 rules. I will very quickly run through the QDMTT and UTPR safe harbor rules. Now, the qualifying domestic minimum top-up tax rule is if a jurisdiction has implemented this rule, then you don't have to do two sets of calculations. You can effectively use this calculation and not actually also do the calculation based on the rules that have been implemented by the ultimate parent entity. The other one is the UDPR rule, and effectively this is more relevant for potentially US headquartered groups, where if you effectively what this rule says is if the ultimate parent entity has not implemented Pillar 2, then for the years up to 31st of December 2026, if the nominal tax rate of the ultimate parent entity is greater than 20%, then you don't have to apply the UDPR. So for example, if you have a group with a US headquarter company and a UK subsidiary, the UK subsidiary can get away with not applying the UDPR up to year 31st December 2026, as long as the nominal tax rate of the UP is greater than 20%. Now, if you move on to the polling question very quickly. So this is a question for the participants. What is the expected application of safe harbors within your business? I'll give everyone a few seconds. Yeah, we'll just give it 30 seconds more. People are still responding, and then we will share the results. So we actually have got quite interesting results. We've got about 38% of the participants saying that they haven't actually considered this. 6% are not relying on any of the safe harbors. About 17% expect that they would be able to claim the safe harbors for more than 50% of their territories and 25% for more than 80%. So it's a complete mixed bag. But I think for the groups which have not considered the safe harbors at all, we would highly recommend that you look into these. And now I'll hand over to the next speaker.
Thanks, Meenakshi. So I'm Ed Gibson, and I'm going to do a quick walkthrough of the full global calculations that you will need to do if you don't meet any of the safe harbors that Meenakshi has just been through. So if we move on to the next slide, please. So I'm going to start at the end. So that is what you're ultimately trying to get to when you do these calculations, which at its simplest is to compare the effective tax rate that you have in each of your jurisdictions that are subject to Pillar 2 with the policy floor rate of 15%. And if you have a rate that is below that 15%, then there will be some top-up tax due in that particular jurisdiction. So how do we get there? So the top formula on here, the jurisdiction effective tax rate formula, is specifying how you work that out. So it's a combination of two things. On the numerator is the sum of the adjusted covered taxes of all constituent entities in that jurisdiction. And the denominator is the net globe income for the jurisdiction. And I'll talk in a moment about what each of those are. Once you've then got that effective tax rate for a jurisdiction, your top-up tax percentage is quite simply 15% minus that effective tax rate. And if that is a positive number, then you will have top-up tax due in that territory. If your ETR is above 15%, that will be a negative number and you don't have anything further to do. We move on to the next slide then, please. So the first thing that you need to do is to work out your globe income or loss. So the starting point for that is your financial accounting net income or loss determined for each constituent entity for that accounting period. And as a quick reminder, the fiscal year here is the accounting period of your ultimate parent entity. Financial accounting net income or loss is the net income or loss for a constituent entity before any consolidation adjustments, eliminating intragroup transactions, that's used in preparing the consolidated financial accounts of the parent entity. So it's not your local company stats, it's your consolidation numbers effectively. Once you've got that, you then make a number of adjustments in order to arrive at the globe base. And we've set out the most common of them in the grey boxes towards the left of this slide. I'm not going to go through all of these in this presentation, which, fair to say, would probably end up taking most of the presentation. A lot of these are self-explanatory. There's probably a couple that I think is worth pulling out that are more common, things that we're seeing more commonly. So the first one is non-qualified refundable tax credits. And what that really means is it relates to tax incentive regimes, of which R&D regimes are the ones that you will see most commonly. And it's the rules effectively sift those into regimes that are good or considered to be good within the rules and therefore don't affect the Pillar 2 position, and those that are not considered to meet the policy objectives and that can therefore be undone effectively by a Pillar 2 calculation. So as an example, the UK R&D regime is considered to be a qualified regime, and therefore if you're claiming R&D benefits in the UK, you will continue to be able to claim those and they won't affect your Pillar 2 calculation, which means they won't be dragging down your effective tax rate in the UK. Another one on there that I'd pick out would be pension expenses. Again, it's quite a common one. So the rules basically follow the UK approach to pensions. That is, you claim a deduction based on what's actually been paid in the year. And if your financial statements include a number that's based on anything else, so if you've used an accruals basis of accounting, then you need to make an adjustment if that doesn't match the amounts that have actually been paid in the year. So that's not really a departure for people who are used to UK principles there, but it would be if deductions are claimed on another basis in that particular territory. And the last one on here I just draw out very quickly is policy disallowed expenses. That basically means any payments of an illegal nature, so things like bribes, which are probably not very common, but just wanted to make that point that it is those types of payments rather than things like we might be considering in the UK, such as client entertaining or whatever. It's very specific to the rules that are excluded within that one. If we move on to the next slide, please. So once you've got your globe income or loss, the next stage then is to work out what the the adjusted covered taxes are, which is the other thing that we need for that equation. So the starting point for that is your current tax expense accrued in a constituent entity's financial accounting net income or loss with respect to covered taxes for the fiscal year. Covered taxes is defined in the box on the right, and for most people that really means corporate income taxes. You'll see on here there are other things as well, which will be relevant for some, but generally it means corporate income taxes. Again, we can't just take that number. There are then a number of adjustments that need to be made in order to arrive at the number we need for our Pillar 2 calculations, which we've again set out the most common ones here on the slide in the boxes on the left. So a couple I'd draw out here. One is uncertain tax positions. So if you have accrued for uncertain tax positions in your tax charge in your accounts, that needs to be reversed for Pillar 2 purposes. So it's a bit of a theme you'll see when we come on to talk about deferred tax, that there's a general aim here to make these rules as mechanical as possible and to try and avoid the need to include judgmental figures. And also uncertain tax position is obviously an accounting judgment, and therefore that has been excluded from the adjusted covered taxes for the purposes of the calculations. Another one is amounts not expected to be paid within 3 years. So if you are fortunate enough to be operating in a territory that doesn't ask you to pay tax for 3 years after the accounting period, unfortunately, the Pillar 2 rules will undo or may undo that benefit by not including those taxes when you're working out what your adjusted covered taxes are. The last one on here I'll mention is the deferred tax adjustment amount, which if we move on to the next slide, it has its own slide because it's a bit more complicated. So what we've done previously on the previous slide is basically deal with current taxes. We then need to now make an adjustment for deferred taxes. So again, the starting point is what's in the accounts, so the expense in the constituent entity's financial statements. But then really importantly, that needs to then be recast using a rate of 15% rather than the statutory rate in the territory in question. So in the UK, obviously got a 25% rate. Most people's deferred tax will be calculated using that 25% rate, unless in a particular industry or if there are particular fact patterns within that. That then all needs to be recast using a 15% rate. So the local country rate has no impact. If the local country rate is below 15%, you don't uplift it, you just leave it as it was. There are then a number of adjustments to go through. Again, similar to what we saw in the current tax part, anything to do with judgments is basically eliminated from the allowable amount for deferred tax. So I mentioned uncertain tax positions, that has an equal impact for deferred tax. Also things such as valuation allowances that you may see if you're accounting under US GAAP in particular. If you have a valuation allowance against a deferred tax asset or liability, then that is ignored for these purposes. You don't make any judgments about recoverability, it all goes in. There is a recapture rule, which is the last point on this slide. So that says that any deferred tax amounts that have been accrued for a timing difference that don't reverse within 5 years basically then need to be added back in that year 5, and that then leads to an adjustment to your covered taxes and defer your Pillar 2 taxes in that accounting period. Happily, there are a number of exceptions from that requirement to do the 5-year clawback, and one of those is tangible fixed assets, which for most people is probably the one that's most likely to be hanging out there for 5 years or more. So that doesn't need to be adjusted in the 5th year. That can continue basically indefinitely, and there's no need to make a further adjustment. We move on to the next slide, please. So now having established those two amounts, we can calculate the effective tax, jurisdiction effective tax rate and the top-up tax percentage, which is, if you remember, the 15% less whatever the jurisdiction effective tax rate is. In order to work out the top-up tax, there are then 3 further steps. So the first one is that percentage gets multiplied by the excess profit in the jurisdiction. And excess profit is the globe income or loss that's just been calculated at the earlier step, less a substance-based income exclusion. And what that is it's a fixed percentage return allowable in respect of staff costs and fixed assets deployed in that territory. So that effectively allows some relief for having fixed assets and staff in a territory. Once you've got that, there is then an adjustment to put in any additional current top-up tax. And for this one, the most likely thing is a deferred tax adjustment amount. So I referred before, if the deferred tax timing difference doesn't unwind within 5 years, that then requires an adjustment to be made. And it's at this point that it comes in. So you don't go back and do your calculation from 5 years ago. You work out what tax would have been paid 5 years ago, and then you add it in to the calculation in that 5th period. You can then subtract from that total any amounts that are paid under a domestic top-up tax. Practically, this is going to be very rare, for the simple reason that if you have a qualified domestic minimum top-up tax, it's likely that you would be out under the safe harbour, and therefore there wouldn't be any requirement to make an adjustment at this stage of the calculation. But in those circumstances that you do, then this is the place that it happens, and it may then reduce your tax due to 0 or below. No refunds, unfortunately. If we move on to the next slide. So this slide is just sort of highlighting a few key points that we sort of picked up on in some of that, but not all of them. So one of the things that's quite commonly asked is, well, what are the common rate impacting items? What's going to drag my ETR down below that 15%, particularly in a high tax jurisdiction, if we're thinking about that stat that Ross started off with. So the most common ones that we're seeing at the moment are things like patent box. So the UK patent box is something that would drag down the ETR in the UK. So that would mean that you may fall below the 15% if you've got a lot of profits sitting within the patent box. Things like non-compliant R&D tax regimes, that does drag your ETR down. As I say, the UK one doesn't, but if you were in somewhere that did, that would have an effect. Uncertain tax positions we've already covered, and pensions and share-based payments. I did talk about pensions, I didn't talk about share-based payments, but in both cases, there is a difference, but there may be a difference between what's recorded in the accounts and what's allowable for Pillar 2 purposes, albeit those last ones, if you're in a high tax jurisdiction, would have to be very significant in most cases to have a material impact. Moving towards the right of the slide, just a couple of other things to bear in mind in the world of Pillar 2. So it's very easy to sort of focus on the calculations and the compliance requirements, which is absolutely the right thing to be doing, given that that's the burning platform at the moment. But they do have wider implications for things that you may be thinking of doing. So M&A would be one. This is now something that's coming in multiple territories. If you're thinking about transactions, things like diligence, Pillar 2 and compliance with Pillar 2, and also actually the effect that an acquisition or a disposal is going to have on your Pillar 2 position, will all become things that need to be thought about as part of a transactions process. So that's really something to bear in mind, and probably something that really ought to need to be thinking about now and going forward. Restructuring considerations, so even outside of a transaction situation, again, this is something that to bear in mind whenever you're thinking about doing any sort of restructuring that has the effect of adding or subtracting entities and territories, moving profits around. If you're doing a business restructuring that has a significant impact on where value is arising in your group, that's going to have there's going to be a Pillar 2 overlay to that will need to be taken into account when looking at things like expected taxes, values, and so on and so forth. Right, so if we then move on to the next slide, we have our second poll question. So this one is quite straightforward. So what is the expected impact of the rules for your organisation? And similar to last one, we'll just give it a minute or so for everybody to put their answers in on this one. somewhat unfortunate that we didn't think to have some soothing background music whilst people were voting on these, but I think it should only be a couple more seconds and then we can see the results. And here we go. So quite an interesting spread here. Most people seem to be at this point unsure about the impact of the rules on your organization, which to be honest is fair, because even the most prepared are using historical data to look at Pillar 2 in past periods before the rules were in force. So it's very much the case that even the best prepared, you don't quite know what the position is going to be going forward. And then just a general spread across the other categories. But I guess for most people, it's more of a compliance issue than a material tax cost issue, albeit we do have some people that it is going to be a material tax cost for. So very interesting results on that one. So that concludes my section. So I'm now going to hand over to Michelle, who's going to talk about the financial statement disclosure obligations.
Thank you very much, Ed. So yes, we're going to talk about accounting for a little bit. If we can move on to the next slide. So this is what I call the good news slide out of the two slides that I'll talk through with you today, because as widely heralded, the ISB amended IAS 12 to introduce an exception from the usual need to consider or account for any deferred tax when we're talking about Pillar 2. That exception is mandatory, so it's not optional, and that's really driven by one of the key things that the standard setters want to achieve here, which is consistency between groups. So it didn't want some groups attempting to include deferred tax, others not, and potentially including it in different ways, because as we've seen already, these rules are very complex. I imagine that that's quite a good news, because I can imagine the general appetite for thinking about deferred tax as well as everything else you need to consider for these rules was probably quite limited. FRS 102 has effectively got matching changes which achieves the same result for FRS 102 reporters, and US GAAP has gone a little bit further with the FASB fairly early on confirming that they see this as an alternative minimum tax, and as such deferred tax will not be in point at all. That's a permanent position for US GAAP at the moment. The amendment to IAS 12 is sort of worded as a temporary exemption, although it wouldn't be too much of a surprise if this was made permanent effectively in the future. There's no expiry date on it, so it's there until the standard setters take it away, but it wouldn't be surprising if that was not done, or at least the need to account for deferred tax on these rules became an accounting policy choice at some point in the future. If we can move to the next slide. So this is probably the slightly less good news, because as the standard setters have said, you don't need to account for deferred tax on Pillar 2. You need to put more detailed disclosure in your financial statements to signal the future impact of these rules to your stakeholders, because you haven't got it in deferred tax, which is where it would normally be. So the disclosure set out, requires both qualitative and quantitative information of the to demonstrate the likely impact. And so there is some suggestions you see on the slide in terms of how groups might achieve that aim in terms of what that income is, but it isn't absolutely prescriptive, and I think at this point it does remain uncertain how in practice groups are going to interpret these requirements and how much and in how much detail they will disclose in practice. Worth noting that there is an exemption from this particular disclosure, not the ones on the previous slide, but this particular disclosure for entity accounts in practice under 102 and IFRS, where the equivalent information is present in consolidated accounts that the entity is included in. It's worth saying that this is a short-lived disclosure, effectively, because once the rules are properly enforced for all relevant group territories, you won't really need this disclosure anymore, because you'll just have your current tax and you won't need to signal the impact on the group. But in the short term, we're probably going to go through 2 to 3 years in which this disclosure might apply to different territories in a group based on the timings of when various jurisdictions plan to adopt the rules. So it's probably with us for a number of years as that landscape changes. We do expect some more to focus on the disclosure in the upcoming busy season, and to an extent this is definitely understandable, because for many territories like the UK, the rules are actually coming into force in the next accounting period. So there's going to be a concern to avoid scenarios in which the actual impact, in the numbers in next year's accounts is very different to what is signalled in the disclosure in the prior year. Also, we expect to see some focus not just on the estimation elements that underpin any of the disclosures and the numbers themselves, but how they've been put together. So the methodology, the source of the data, and its completeness. In practical terms, we would always encourage early auditor engagement. So speak to your auditors early on about their approach, what information they are expecting to see to support your disclosure, and obviously what you've done so far and how you see that disclosure working for you. And don't be afraid to challenge if you think that there are simpler and easier ways, perhaps involving a bit less of your time, to get your auditors comfortable with a particular risk area or judgment or piece of data. And hopefully in that way, we can all get through this reporting cycle in as painless a way as possible. I think that was about all on disclosure, and I'll hand over next to Frederick.
We seem to be having a sound issue with Frederick. I'm not sure why we can't hear you, Frederick. Give you a minute or so to fix that. If not, I can take over.
Hear me now, Ross?
Yes, perfect. Thank you.
All right. I just switched off mic. Thanks. So if we could move on to the next slide, please. So we've created a compliance process roadmap, which would definitely help you in a painless process, Michelle, as you called it. It shows a step-by-step process with steps ordered by priority. And it also takes into account the transitional relief of the safe harbors that we just described. And similarly, I think there are 2 milestones in it. One is the Q1 2024 financial reporting. And then eventually in 2026, there's the actual tax compliance and the submission of the Pillar 2 filings. Doing it in this order and an order of priority will help making Pillar 2 compliance a manageable process for you. As a starting point, we would recommend that you create a Pillar 2 profile of your group. And that would be to determine, does your group meet the revenue requirements, do certain of the exclusions apply, and which of the Pillar 2 rules would actually apply, in which of the jurisdictions where we're based, and as of when. And this determination will help you in the next process. The next step would be to perform the safe harbor analysis. And doing this, as we saw in the poll and the results of the poll, it will help you prioritize your efforts, because the jurisdictions who satisfy the transitional safe harbors, they benefit from a significant reduction in compliance efforts, and the top-up tax will be nil. Similarly, the jurisdictions that do not satisfy the safe harbors, they will require a full globe calculation. And then looking at those jurisdictions, it helps ordering them by size, by risk, by complexity, and then grasp the magnitude of the impact of Pillar 2. And in addition, it might be sensible to deep dive into those jurisdictions that may potentially cause a significant amount of undertaxation, and try to understand those elements that are the root cause of the undertaxation in those jurisdictions. And once you have a clear overview of the jurisdictions that require full globe calculations, you might want to evaluate your ability to extract the relevant data points from your systems and to identify whether there are any data gaps between the required data and the data that your systems can currently provide, and in what detail. By having a very good understanding of your activities in each jurisdiction where you're based, this will show you that you may likely not need all the 150 data points for each of the jurisdictions where you're based. So again, a filtering process helps you make this a sensible process. Subsequently, performing this data analysis on time, it will help you to give input to your systems and make sure they're fine-tuned, they provide the relevant detail. And that, of course, is very helpful in a more automated compliance process going forward. Similarly, by evaluating the data requirements and the data you can provide in your systems, there might be opportunities to look in automating the extraction of data from your systems into your Pillar 2 modules or in the calculation of your Pillar 2 calculations. And what we're seeing in practice is already clients are using various solutions to that and to automate parts of this process. As Ed mentioned, once your systems are set up, there will be a task for you as a tax department to ensure that those Pillar 2 considerations that you now can grasp for your group, that they are embedded in all the planning and operational activities of your group. And similarly, as was discussed by Meenakshi, reliance on the safe harbors that may actually affect some of the intercompany restructuring that you may do because the transitional date is extended by the duration of the safe harbors. Once you have all of this set up, likely with some manual interventions, you will be able to provide the quarterly Pillar 2 calculations that will be relevant for your disclosures in 2024. And then it becomes, having that in place, then it becomes a matter of organizing your tax compliance affairs of the deadlines 25, 26. And to start with, we would really recommend you to identify the local specifics in each of the jurisdictions where you're based, both for compiling the minimum tax return and filing the tax return, because that information is critical to establish a sound process. And similarly, we would recommend you to organize a clear process around the globe information return preparation and a review of all the jurisdictional elements, so the information on each jurisdiction where you're based, to have a clear process on who provides the data, who reviews the data. And similarly, we would recommend you to have a clear process and responsibilities in place for the tax preparation and tax filing process between your central tax team, your local tax and finance departments, and your external tax accountants and tax advisors. Following a step plan like this step plan, which we think is very sensible based on priority, this will set you ready to eventually file your first batch of Pillar 2 filings in 26, and more imminently, your Q1 financial disclosures in 2024. If we could move on to the next slide, please. We've summarized the steps in my previous slide in a much shorter format in the next slides, and they could be summarized again as 10 steps. So having gone through the compliance process and the potential step plan that you might follow, we're very keen to hear your views on the next polling question. And that would be, what is your expected disclosure position for Pillar 2? I'm very curious about the results. All right, let's see. So almost half of you have not yet considered your disclosure position yet, even though you might be quite soon in a position to having to disclose. 11% of you will make a disclosure. That work is still ongoing, still working on the preparations. I think 30 of you will grab the opportunity for a light touch disclosure within the rules that Michel discussed. And 14% of you will be making a more detailed disclosure, explaining the status of work and potentially the outcome of your calculation. So again, very much in line with the previous polls, very clearly a scattered audience with different stages in preparation for Pillar 2. I'm also very keen to understand what this means for my next polling question, the fourth polling question. So what is your primary concern regarding the implementation of the Pillar 2 rules? All right, let's see the results. Again, a very diverse answering among you. So 9% expected an additional tax cost, much in line with an earlier polling question. 49%, of course, are very worried about the impact it has on your resources, the additional burden it places on your financial and tax team. 26% of you will be looking at implementing systems to support your compliance, potentially resort to specific Pillar 2 technology, and 16% are concerned about the business costs of the resource and system requirements. And I think based on the conversations we had, we can fully understand those concerns that you ventilated here. So Ross, I propose going back to you.
Great. Thank you very much, Frederick. So hopefully that has been a useful, albeit rather rapid overview of the rules and the immediate actions to focus on. I think just a few reflections from my side in terms of key takeaways. So as you can see, the rules are complex and there may be a significant amount of work to do in order to assess the impact of the rules for your organization. I think as we've heard, that work includes not just technical assessment, but liaison with your auditors, thinking about accounting disclosure implications, considering impact on existing processes, which could include your current country-by-country reporting processes, and making sure that those processes are aligned to enable you to access the safe harbors, should you choose to do so. Also, processes such as senior accounting officer requirements, which we have here in the UK, and making sure that you've got documentation and appropriate governance around your Pillar 2 compliance and reporting approach. Some significant systems and data challenges as well, which we'll be diving into in more detail in a subsequent webinar. There'll be a need to think about training requirements across your organization, with different parts of your business maybe needing training in different aspects of the Pillar 2 rules. And so how do you deliver that effectively? And of course, tax technology considerations as to how can you take what is a very significant compliance challenge and make it a little bit easier in what is no doubt a resource constrained environment in many of your organizations already. However, I think the positive news is that it is possible to make that workload manageable by breaking it down into steps and looking at approaches to simplify and eliminate some of that complexity, to enable you to identify the key areas of focus for your particular organization. And that's a lot of the work that we've been doing with organizations, has been to help them pick through that complexity and find the things that really matter, and move forward with pragmatic and practical steps. So here are the further webinars in the current series. So on the 17th of January, we'll be talking about some further jurisdictional viewpoints and nuances around implementation of the rules. As I mentioned at the start, the rules are based on an OECD framework. Different territories are taking different approaches in terms of whether or not to implement and the timing of implementation. And there's also a couple of nuances in terms of the specifics of that implementation. So we'll be diving a bit more into that on 17th of January next year. We'll then have a deeper dive into systems and technology matters on the 21st of February 2024. As I mentioned, there is a significant data and systems piece to this. We've got a view of the full suite of available solutions on the market, and we've been guiding a number of businesses to determine what solution may be most appropriate for them, and then supporting with the implementation of that. Then webinar 4 is a deeper dive into compliance and reporting, which we're scheduling for the 2nd of May 2024, by which date we should have more details, more enacted legislation with the specifics of some of the notification and reporting obligations in local jurisdictions and how they fit together at global scale. So that's where we're going next. As mentioned in some of the Q&A, we'll share with you the recording of this webinar and the slides shortly after. We have been answering some questions in the Q&A live, but they've been flooding through and we haven't necessarily caught up with all of them. But maybe if I just sort of offer a summary of a couple. So there's been a few questions around specific rate impacting items, with a particular focus, I think, around the interaction with deferred tax accounting. And if I were to answer this at a super high level, broadly speaking, if you've got a particular tax allowance, such as, for example, a first-year allowance or some form of accelerated depreciation for tax purposes, which gives rise to a corresponding deferred tax impact, you wouldn't necessarily expect that in itself to pull your effective tax rate for Pillar 2 purposes down, because you can bring into account the deferred tax impact of that. However, that is subject to a couple of caveats. That firstly, the deferred tax, as we've heard, is only recognized at 15%. And so it can have a downward pull on your effective tax rate for Pillar 2 purposes, which might make you more exposed to other rate impacting items for Pillar 2 purposes. And there are also the need to make certain adjustments to the deferred tax figures. So off-balance sheet losses might be brought on balance sheet for Pillar 2 purposes. There might need to be adjustments in respect of certain long-term deferred tax liabilities that don't unwind in a period of 5 years. And equally, you may need to exclude deferred tax where the underlying item of income or expense that underpins that deferred tax balance has been excluded from the global income or loss calculation under the separate rules. So there are a number of things to think about in relation to the deferred tax. There's also been some questions relating to disclosure obligations, and just to clarify, there are going to be accounts disclosure obligations for any accounting period ending on or after 31 December 2023 in most cases, certainly for IFRS and US GAAP reporting. But you won't necessarily have an obligation to disclose at an interim financial statement perspective if your interim financial statement period is ending before 31 December 2023. And then finally, there's some questions about the long-term future of the safe harbors. And just in terms of that, I think we don't know with certainty. if I was a betting man, I'd say I would expect that the current safe harbors will morph into long-term variants, but we don't yet have any precise commitment as to exactly what those will look like. But we will, of course, keep you all updated as we get more detail. So with that, we've come to time. Thank you very much again for joining us. Registrations for the next series will come out very shortly, together with the slides and the recording of this webinar. And you'll also have the contact details for the speakers today. So please do feel free to drop us an email if you'd like to explore any of the topics we've discussed in more detail. But with that, I'll say goodbye for now. Happy holidays if we don't speak to you before, and hopefully see you on the 17th of January next year to go into some of those specific territory nuances. Thank you very much.